So let me introduce Ron very briefly because we want to use every minute usefully.
Yes.
He's originally, I believe, a systems engineer, if
Yes.
I'm not mistaken. Yeah,
That's right.
So in common with a number of us here, and he's originally from Australia, but he's now heavily involved, I believe, in, well, I'll let him in information systems, information technology consulting. So he's not, at least previously, solely a trader, but he's made a tremendous impression on everyone on capital discussions, and I know in other forums also. A couple of years ago with his discussions of volatility and other detailed technical analyses of the internals of options trading. And even more so now, he started looking into hedging, and he's developed a very comprehensive framework for hedging. And I won't say much more, but I'll let him say anything he wants. The other thing is I invited Ron to, please tell us about tradingdominion.com, which is his new educational venture and community venture. And for those who want more details, they can go to tradingdominion.com. And I asked Ron to tell us a little bit about that, but he said he'd rather get right into the technical stuff at the beginning and do that at the end. And we're going to reserve the whole 2 hours. And we got people still coming in here. Hi. For whatever he wants to do with it, because he's an extremely impressive speaker. And let's give him a warm welcome now for Ron Bertino.
Great. Thanks, Don. Okay, so today, I guess most of you probably already know me, I'm guessing, if I've been around the community for quite a few years. The thing that I'm doing now is Trading Dominion, as has been explained. I've actually switched. I'm no longer doing the IT stuff after 20-something years. I'm now doing the Trading Dominion thing full-time, and trading, of course. And as part of that, today we're going to be covering the concept of a hedge space trip trade. And I'm actually going to be extending the stuff. I know that some of you have probably watched the presentation that I had on YouTube about this topic. So I'm going to kind of skim through it very, very quickly so that we don't, rehash the same content you've likely already seen, and to give you a bit of extra deep dive detail. And we're also going to be covering the topic of portfolio margin, which is a really important thing to understand at least the basics of. And hopefully you'll start to realize the types of things that you can actually do and the types of trading that we do. And one of the things that's specific to Trading Dominion is, there's hardly any other communities out there that do this, but we focus primarily on building trades that take advantage of portfolio margin or span margin. And when I say that, most people automatically think of, well, that's a two-edged sword because it's dangerous and blah, blah, blah. You'll see, hopefully by the end of today's session, that it's not, providing you know what you're doing. So again, today's session, I will try to give you a foundation in how portfolio margin works and at least start to open your eyes through to the potential of what you can do. And then we'll see a couple of trade types and so forth that we trade in our community as well. All right, so I don't like to kind of do much of a deep dive in through to my history and all that kind of stuff. I just kind of want to get to the meat and basically, hopefully, give you some stuff that's useful and applicable. So let's dive in. Oh, and by the way, before we do, if there's any questions, I've got a chat window up over here. Sometimes I may get a bit engrossed in the session, so Don, if I miss something, please yell out. And if any of you that are on the Zoom meeting or the WebEx kind of thing, if you would like to ask a question via voice instead of via chat, just let me know via chat, and then I will promote you to a panelist, and you can talk via voice if you want to. All right, but feel free to ask questions.
Ron, if I can just add one thing to that, and that's that, we can involve people in the meeting room too the same way.
Absolutely. All right, let's dive in. All right, so we're going to start with an intro to the concept of portfolio margin. Now, if we were to look at a risk graph like this, the trade isn't necessarily important. This is basically a road trip trade, which most of you know. And I were to ask you, what is the RegT margin? Hopefully pretty much everybody in the room should instantly be able to know how to figure that out, right? All we're going to do is we're going to look at that bottom expiration line. Typically it's on the left, the one that's lower, but it can be on the left or on the right. And the deepest level that that expiration line goes to is what's going to be your RegT margin. All right, so that's pretty simple. But what you may not perhaps be all that familiar with is if I showed you the same graph and I asked you, what is the portfolio margin of this, just roughly speaking? So can anyone take a guess? Or can anyone take an educated guess and look at the graph and tell me a number that would be pretty close? Keeping an eye on the chat. No takers? All right, so most people would need to see this value calculated by the software, right? So if you're using Interactive Brokers or the TOS platform, then the software does it for you, right? But most people don't understand how is that number derived? And more importantly then, how can I leverage that information to now design trades that are going to take advantage of portfolio margin versus ones that don't, okay? So equities and indexes work differently when it comes to portfolio margin calculations. But for this presentation, let's just focus on indexes, primarily SPX, which is what we normally trade, but it would be basically the same thing in RUT as well. So if we look at SPX, the way to approximate the portfolio margin requirement is where, for those of you that aren't familiar with OptionNet Explorer, so up here you can see that it says, minus 2.1, minus 3.1, and so on. This is basically the price change from at the money. So we've got at the money here, and then as we go down here, so this level here is minus 6% from at the money, all right? So if the market were to drop by 6%. So the way that portfolio margin is calculated in indexes, especially with SPX, is that they look at 12% down, right? And what they're looking for is not the expiration line. They're looking for the T plus 0, okay? So we go from at the money, we go down 12%, right? From there, we basically go down through to the T0, which is here, not down here, right? But we're basically going to the T0, and then we look at what the risk is going to be. And in this case here, the portfolio margin for this particular trade would be, just to ballpark it, roughly about $9,000. All right, now that is the left-hand side, which is normally for most trades that we tend to do, and you probably do as well, that is where the risk is going to be. But there's plenty of risk on the upside if you have trades that are structured that way. So think of something like a short straddle as an example, right? So on the upside, what they do is they go up 10%. All right, so again, from at the money, we go this way now, plus 10%. And then we go down to the T plus 0, not the expiration line. And then we have a look at what the risk is. So here, there's essentially no risk on the call side, or basically on the upside, I should say. But on the lower side over here, at minus 12%, we have 9K of risk, right, at my T0. So they look at those two numbers, they then take the biggest of those two numbers, and that is your portfolio margin. Okay, so that is how you can approximate your portfolio margin simply by looking at a risk graph without needing the software to do anything for you. Okay, nice and easy. Now, similarly, if we kind of step ahead and we were to ask, well, what would the portfolio margin be, not on the day that I initiate, but what would it be, for example, at 16 days to expiration? So this is once the trade has roughly 2 weeks to go, which is when a lot of people choose to close out the trade, right? So most people may not like going right to expiration. They'll say, I want to get out at 7 DTE or 16 DTE, 1 or 2 weeks, and just get out regardless of what my profit might be. So if we look at that, I know this is very small writing, but if you look at the pink line here, the pink color is showing you that there's 16 days to expiration there, right? So if we were to look at the portfolio margin at 16 days to expiration, it's the exact same thing. We basically go 12% down until we hit that pink line, right, which is the 16 days to expiration line. We then go across, and you can see here that our portfolio margin, assuming price doesn't do anything, if price just stays right here, doesn't do anything, okay, simply by the fact that my T0 has gone from here down to here, right, implies that my portfolio margin is going from $9,000 to roughly $14,000. Okay, my upside risk at plus 10 is still 0, so that doesn't count really. So, but that's important, right? Because my initial PM or portfolio margin was $9,000, but it doesn't necessarily stay that way. So you can see here that it's almost doubled. All right, so it's almost gone through to double that number. And by the time that you want to get out at 2 weeks to expiration, you're now looking at a portfolio margin that is much higher. Okay, so simply by looking at these lines here at 12%, you can get a feel for the efficiency of the portfolio margin of that particular trade. Okay, so, and you can see here just how close this pink line here is through to the expiration line. And the expiration line is your RegT risk. All right, so if you're getting out at 2 weeks prior to expiration, you can see here that the portfolio margin during the life of the trade, which you may have initiated roughly at about 75 days, you get out at 16, but during that life of the trade, you can see here that the PM is going to almost match the RegT risk. Therefore, you are getting no benefit whatsoever from portfolio margin. You may get a little bit of a benefit at the start, because remember that at the start, your margin is here rather than here, okay? So that may have cut down your initial margin by 40%. But by the time that you actually have to get out, there's no difference, right? At that time, your PM equals your RegT. Therefore, that, and this is not to pick on, in this case, the road trip, right? I could put up an M3, I could put up any at-the-money structure, right? And what you'll find is that almost all of the popular at-the-money structures that you'll see are almost 100% inefficient when it comes through to the use of portfolio margin. Because again, by the time that you get out, your margin for PM is basically the same thing as RegT. So there's no benefit, right? So that is that part. That's a pretty important thing to understand. So let me just quickly pause there. Any questions on that?
Ron, I guess we should just maybe clarify that who can get portfolio margin, or how can they get it?
Okay, all right, sure. So this depends on the brokers, right? So what's going to happen with the brokers, let me kind of tell you about TDA, which is where most people will end up landing, and I'll get to why in a second. But with TDA, basically what they require is a minimum starting capital of $125,000. After that, and you do have to pass a test, okay? There's a test. They'll test you on synthetics and various other things, right? But not that difficult, as long as you know if you've been trading for a while. But it starts off with $125,000. Thereafter, though, you need to maintain that balance above $100,000. Okay? As long as you're doing that, you can get portfolio margin at TDA and be happy. Other brokers have different starting limits. So, for example, other brokers may have a starting limit of 150. I've seen one that had a starting limit of about 200. But TDA is pretty attractive because, again, you just with $125,000, I know it's a fair bit of money, right? But with $125,000, you can get into portfolio margin. Now, what if you don't have $125,000? Well, there are options, right? Because even though you may have a RegT account can apply for futures options trading. Okay, and it's just a matter of picking up the phone saying, enable me for futures options. They'll say, do you know what you're doing? You say, yes, and they go, done, right, pretty much. So with futures options, you're now going to get access to span margin. And span margin, there are very slight differences between portfolio margin and span margin, but roughly speaking, they're very, very, very similar. Okay, so that implies that, let's say you've got a $50,000 account. You simply apply for futures options and you can now leverage span. And span is going to relatively give you the same amount of leverage as PM. In some instances, actually, SPAN can give you more leverage than PM. So again, there are just slight differences, okay? Now, this is kind of a big topic, actually, but the issue with SPAN, you might say, is it actually exactly the same thing between the two? There's not, right? So we have, let me kind of clear this out. So we have PM and we have SPAN. And again, this could be like an entire 1 hour session easily, but let me do it quick, right? So with PM, what's going to happen is that from a commission perspective, you're going to be paying, this varies from person to person, depends on the total account size you have, it depends on the volume that you do, but you can get, you know, the majority of people should be able to get something like $1.25 a contract, okay? And that's with no ticket, right? If you're doing, you know, a decent size of volume, like most, I'd say a large portion of the people in my community, myself included, right, we're basically on 75 cents a contract, no ticket. And the really nice thing is that TDA eats the exchange fee, all right, providing you're on a rate that is 65 cents or higher, all right, then TDA will eat the exchange fee, and the exchange fee actually is 65 cents for SPX. So long story short, with PM, you're simply paying, like in my case, and like most of my members in the community, 75 cents a contract, which is really nice, okay? They've gotten very aggressive with their negotiation and competing against others. So it's not that hard to get 75 cents. And but again, even if you're on $1.25, that's still a pretty decent rate. No ticket charge, no exchange fee. All right, you go anywhere else, and regardless, even if you get a match of 75 cents and you say, oh well, you know, I'm with Interactive Brokers, I also have 75 cents. Okay, but you're paying 65 cents exchange fee there. TDA are the only broker that I know of that eat the exchange fee, and that's a huge thing, because again, 75 cents compared to 65 cents that you don't need to pay, that's essentially almost half the commission that you'd be paying anywhere else. All right, that is with portfolio margin. So therefore, portfolio margin is very nice. Okay, now let's look at span margin. I'll do this over here. With span margin, the commission structure is very different. So with TDA, it is horrendous. It is $2.25 a contract. Okay. No ticket though, so that's fine. But the exchange fee is not eaten by them, right? They will charge you the exchange fee, and this is a 55-cent exchange fee per contract, right? So you basically add these two things together, and that's what you're paying. But that's not all. Why? Because when you're trading futures options, you're going to be trading the E-mini S&P futures options. The contract of the E-mini S&P is half the size of SPX. What does that mean? That means that if you were to be on this side over here trading portfolio margin, and you're sizing a trade such that you're making, let's just pick a number, let's just say, you know, one tranche or whatever may give you, one or two tranches may give you $1,000 profit in SPX. And let's say that you're doing that, just to pick a number, let's just say with 10 contracts. Then if you wanted to do the same thing in the span margin world, then since it's half the size, you would need to do 20 contracts to get the same amount of money out of it, right? To get $1,000 out. So you're not only having to pay $2.25 plus 55 cents, right? So what, $2.80 a contract. On top of that, you have to do double the amount of contracts that you would on SPX. Okay, so on SPX, you would be doing 10 times 75 cents is it. And then on the left, you would be doing 20 times $2.80. Right? Significantly different. So what do you do? Portfolio margin is awesome at TDA. It is by far the best broker that I've seen that has a super competitive rate, because primarily they eat the exchange fee and they can price aggressively, and the platform is great too, right? So if you're doing PM, go with TDA. If you want to do futures options, TDA is not the place to be. It is one of the worst. So what can you do? You could go through to, as an example, Interactive Brokers. Interactive Brokers, their standard rate is 85 cents a contract for futures options, right? No ticket. So that's a lot better than 225, right? But you still have to pay the exchange fees. Okay, so that is a quickie between SPAN and PM. In later slides, I'll tell you about exclusive deals we have within our community that beat this rate and bring that cost even lower than 85 cents. Okay, but I'll get to that later on. So did that answer that question, or would you like more details?
No, that's super, Ron. It's the best treatment of that subject I've seen anywhere.
Okay. Yes. All right, let's keep going. So here's a tricky one for you, right? So let's do a little quiz. So you remember what I mentioned before, right? You go minus 12% down and plus 10% up. You look at your T0 risk. The maximum risk is your margin, roughly, your portfolio margin, okay? So look at this trade. This is obviously a long straddle. What is my RegT risk? That's easy, right? I just look at the bottom there. It's close to $200,000. This is like 20 contract long straddle, something like that, right? But if I now said, what is my portfolio margin for this trade? Who would like to take a guess? What's my risk? This one's tricky. Any takers? All right, so let's break it down, all right? Same thing as before. We look at 12% down at T0, but this is a positive number. So if the market were to come down by 12%, we'd be loving it. We'd be over $250,000 richer, right? So you go, okay, I'm not sure what to do there. What about on the upside? On the upside, it's exactly the same thing. At plus 10% at the T0, we're still making $250,000. So what do? Well, let's cheat. Let's go to the software and get the software to tell us, all right? So we're going here through to Thinkorswim, and you can see here I've basically done a straddle, 20 contracts, and this number here is 0, as in this is the at the money slice, okay? So it's basically 3 down, and you can see here that it's saying $1,500. Well, why the hell is it charging us $1,500 if I have no risk at minus 12% and I have no risk at plus 10%, right? Doesn't make sense. You'd think that something's weird, and it is. So what happens is that there's something else to cater for this scenario. And in the scenario that there is no risk at T0, at minus 12% and at plus 10%, what you'll get charged with is what's called minimum margin. All right, and that's this number here of $1,500. So how is that? Someone's saying cannot see my toss screen. You should be seeing the PowerPoint slides. Do you not see that? Great. No? What do you see? Okay, yeah. Is everyone else seeing my PowerPoint slides okay? Yeah, Don is saying it's okay. All right, good. So how is minimum margin calculated, right? So we know how to estimate roughly margin based on risk of T0 at minus 12% plus 10%. What's minimum margin look like? Minimum margin simply looks at the total number of contracts your position has. They multiply that by 37.5. In this case, if you go back, right, notice that it's a 20 contract straddle, but the number of contracts in total is 20 and 20. So that's 40, right? So if we look over here, we then fill that in as 40 as total number of contracts, multiply that by 37.5, and that gives us the magic number of 1,500. Okay, so this right here is the minimum margin that's being charged for this particular trade. Now, if you're used to doing RegT trading, you're conditioned to think that RegT risk, your margin, is your total risk. Okay, does that imply that the total risk in this position is $1,500? Heck no. Right? If you've traded a long straddle, you should know this, right? You've got two big risks with a position like this, right? One of them is, let me kind of draw it here, right? This one, right? You've got $1,500 of theta decay per day. That's not nice, Okay, so in other words, day by day, this line will start drooping more and more and more, roughly by about $1,500. Okay, the other risk you have is this lovely number here, right? And that's a positive vega of 16,000. Okay, so if you were to put on this position after a spike in IV and say, well, I think we're going to bounce and we're going to move hard because we always get like a V bottom, right? So you wait for the pull down and you say, okay, I'm going to put on a straddle here because I think we're going to move big one way or the other. Well, the other thing that happened on that move down is that IV spiked, right? And if the market does have a V bottom and does exactly what you thought, then even though you may get a very violent move up, you're also going to get a crush in IV, right? And if you have 16,000 positive vega and you get an IV crush, you're not a happy chappy, okay? So both of those conditions would sink that T0 down by a significant amount of money, much more than 1,500, okay? And this is the kind of stuff that freaks people out. They say, well, my margin, I mean, I've got huge leverage here, and you do, right? But you've also got a lot of risk. So this is the kind of stuff that we learn to do at Trading Dominion, right? We learn to leverage portfolio margin, but the irony is we leverage it to create safer trades. And that's the stuff that kind of typically blows people's mind, right? They go, what the hell are you talking about, right? Portfolio margin is risky, right? And this graph right here proves it, right? It's margin of 1,500 and you could lose many thousands if something goes wrong. And that's true, but we don't do this trade, right? We construct trades that leverage the power of portfolio margin, but in a way that gives us safer trades than RegT, believe it or not. All right, so that's minimum margin. Any questions on that about minimum margin? It's pretty straightforward. All you got to remember is contracts times 37.5 and you're done. Okay. All right, so this is now the opposite of what I was explaining before, right? Because if, let's say that you get a huge bull run up in SPX, right? And IV is nice and low at 10. Okay, and we're kind of used to that now, right? With very low IV for a long time. But IV is at 10, sorry, VIX is at 10, and you put on a straddle, right? Because you're expecting now a big dive. Let's say that it's come up through to prior resistance or something, whatever. So you might then look at this and say, well, yeah, but my RegT risk is $90,000. Yes, it is $90,000. And your portfolio margin, as you saw, is going to be about 1,500. Costs you nothing to put this thing on, right? But now what's going to happen is you say, well, yes, but look at my risk, right? All of this can work against me. Sure, but it's like doing anything else, right? You're basically reading your instrument panel, right? And what do you have here? You've got negative theta of 659, so that's not good, right? If the move takes too long to eventuate, you're going to get killed. But you've got 7,600 positive vega, right? So if IV has gone low and then you get a crash, IV spikes, all of these lines actually go up, okay? And you can actually be out, hopefully, in just a couple of days. So your risk is theta, but you've got vega behind you. And you might say, well, I thought you just said in the prior slide that if IV crushes, you can get destroyed with a long straddle. Yes, but if VIX is at 10, can VIX go to 1? No, right? The lowest VIX has ever gone is, I think it was 8.5 ever in history. Okay, so VIX just doesn't go under that. So so you've got like maybe 1.5 points of risk of IV, but not more, right? It's not going to go, VIX is not going to go to 1. All right, so those are the things to keep in mind. So the concept of calling, people say, RegT risk is the real risk, not really, right? Again, in this case, if VIX were, let's pretend that VIX were at 9, right, and you put on a long straddle like this, the vega risk is absolutely minimal, right? So your only real risk is theta. So as long as you're managing your theta, you're good, okay? And you can gamma scalp this and make some money and do whatever you want. Another scenario, if you've not seen this graph before, you might go, well, that kind of looks very similar to what you just showed. Is that a long straddle? It's not, and it's a structure which not many people are familiar with. It's called a reverse calendar or a short calendar, Okay, so most people, if you've seen a graph that kind of looks like this, that's a calendar, right? It's a long calendar. So this is an upside down long calendar, right? Or a short calendar. And the reason that you may want to potentially consider a structure like this is if you're expecting big movement, but you're expecting an IV crush, right? Go back to the first scenario that we talked about. What if we've had, you know, actually, let's not do we've had a violent move down, IV has gone high, okay? Now you're expecting a bounce, a violent move up, but you know that if price does move up, then IV is going to crush. So you don't want a long straddle. We saw that before. You get killed, right? Because with the IV crush, if you're long Vega, you're going to get destroyed. So put in a position that takes advantage, or a position that simulates your expectation for what you want for IV, right? You want wild movement. So, you know, you're probably expecting it to go up in this particular case if you're back at support, but you want a structure that has negative Vega, okay? So if you do that, your risk is still going to be your negative theta in this particular case. So it does work similar through to a long straddle, but it's the opposite Vega, long story short, okay? It's a negative Vega structure. And you might go, okay, interesting. I may look at that. Well, I can bet that you're not going to look at it, right? And this is why. If I asked you what's the RegT risk of this particular trade, what do you normally do, right? You go down to the bottom, which is here. You look to the right. You might say, okay, the RegT risk is likely minus $37,000. That's what they're going to charge me, right? Well, if you can see that number down there, $541,532 of margin is what they're going to charge you for a reverse calendar in a RegT account. This is why nobody does a reverse calendar in RegT. It's insanely expensive from a margin perspective. And you might go, well, how is that possible? My so-called max risk, if that's what you're used to looking at, is down here. And that's $37,000. How can they possibly try and charge me $541,000 of margin, right? Well, what's happening is that they're looking at your options, and notice that at the back, you've got shorts and you've got longs in the front. You might say, so what? They're covered, right? I've got longs covering my shorts. Yes, but that's during the first 67 days. What happens when these guys expire? You're now left naked with naked shorts in the back. So what happens with a RegT account is they say, okay, we're going to charge you the margin as if you were naked, even though you've got options in front of them covering them for a certain amount of time, right? So that is a reason why they charge you insane margin for a reverse calendar, and the likely reason why none of you would have done it before. It's just impossible to do in a RegT account, right? So how do you do it? Like you probably guessed, you do this in a portfolio margin account or with futures options, and you leverage span. Okay, so there you might say, well, what would the margin be? Well, let's run through that exercise again, right? So you take a look at your price, well, I was going to say price slices, but we're basically looking for minus 12% down. You can see here, this is 8. So minus 12 would be, you know, somewhere here, right? If I continue extending this line and I look at minus 12%, no risk, that means profit, right? And then if I look at 10%, which would be somewhere up here again, no risk, that means profit. So you can see it's very similar to the long straddle, okay? So this right here would be a minimum margin trade. What do? We have 20 contracts, another 20 contracts, 40 contracts times 37.5, margin of $1,500 for your reverse calendar. Same thing as a long straddle. Okay, any questions on that? I got a question here from Rick. He's saying, is that true for futures options? Rick, unfortunately, I don't know what you're referring to. So when you guys type in, you think I covered it? Okay, good. All right. Yeah, so if you type something in the chat, just try to, rather than ask a relative question, try and be specific about what it was that you want to know about, so that if I do come back to your question after a couple of minutes, at least we have context, please. Okay. All right. Now, still hammering on the people that say RegT risk is a real risk. All right. Well, let's say you're trading a broken wing of some kind, right? So some kind of structure like this, and then the market comes against you, right? and then your original T0 was, ugly, okay? And you go, oh, I don't want that, but I want to stay in the trade. So what do? You hedge yourself. How do you do that? Well, many ways, but one way that some people do is they basically buy a long put, right? What does that do? That picks up this line and does something like this, okay? And this is something that people do all the damn time. And yet I have an issue with it, because then you've just contradicted yourself, right? Because if you say that this is your real risk, which is $16,000, then if you've just put in a long put, to marry those two things together, you've not reduced your risk. Your risk is still $16,000, right? So why have you bought the long put and not just exited? Well, because you know that the reality is T0, right? On top of that, notice your Vega. Your Vega is positive 333. So if the market does crash and keeps coming down, what's going to happen to IV? IV is going to rise, and you are positive Vega. So are you worried about a crash like this over the next 2 or 3 days? No. Okay, if the market crashes, this line is going to pick up even more, and you're going to make even more money to the downside because you're positive Vega and you're flat delta, right? So again, reality is the T+0, but you can't just look at a T0 without understanding the trade. You have to know how the trade morphs. You have to understand how the trade reacts to a spike in IV. How does it react to a skew change? How does it react through to a parallel shift in IV, all right? How does it react to a massively bullish market, massively bearish market? You have to know all those things because you have to understand your T0. But that's reality. Reality is T0. It's not expiration line, right? Reality is expiration line at expiration, not today, all right? You've got to manage your T0 all the time. And I don't care if you trade RegT or if you trade PM. T0 is reality. And your job as a trader is to understand how that's going to change in order to manage your risk. All right. Another thing that can happen is splitting off from this concept of, everyone is locked into the mentality of a single trade, right? I've got an M3 on, I've got a road trip trade on, I've got a blah on. Okay, what else do you have on? Is that the only thing you've got on? Because if the answer is no, and you've got other trades on, you have to understand your entire portfolio, because you may have lots of risk in some other trade you're not actively looking at. Right? So what I'm getting at there is that if you are simply saying, well, my RegT risk is this blue line here of this particular broken wing, right? Is it? Well, if you're looking at that trade in isolation, well, I think that's not valid, as I just explained in the last slide, right? Your risk is your T0. But the point is that you might have a trade like this, right? Something that's got nice negative deltas, or it may not even have the swing. Maybe you've just got a nice big put debit spread down here, which is acting as a hedge for your other trades. So if the market were to come down, you're actually writing negative deltas, which means you're making money. And this put debit spread over here, as an example, is going to be positive Vega. So that's going to hedge your negative Vega from this particular trade here. Right? But my point is that you want to and need to learn to manage your portfolio, all of your trades together, not just one trade. And your risk is definitely not the risk in that one trade, right? Because you may have another huge hedge sitting behind it that is going to make you tons of money if the market does continue in that particular direction, right? So in other words, what matters is the T0 of your portfolio. That's what's important, right? You need to learn to understand how that's going to morph and change and control that risk. That is the real risk, not the expiration line. All right, so this is a sample of a PDF that you can find on SIBO, and what they do is they basically show you examples of the differentials between RegT margin, which is this thing here, they call it strategy-based margin requirement, same thing here, and versus portfolio margin. All right, the differences here, why there's these two columns, this is for equity options, this is for indexes. Okay, so we're basically typically looking at the right-hand side, but if you trade equities, if you look at something like a collar, if you do collars on equities, notice here, a collar here, 100 contract collar is going to cost you almost $500,000 in margin, right? If you're doing that with PM, it's going to cost you $33,000. Okay, so the differences can be staggering, right, between the two. But remember, it's not about getting leverage, because that's a big two-edged sword, right? We're about trying to design trades that leverage portfolio margin, sure, yeah, but that enable us to create safer trades than we can even trade with RegT. That's the key of what we're trying to do. All right, last thing before we get into the space trip, 47 minutes already, okay, is just letting you know about, because people kind of freak out about total downside so-called risk, right, with RegT when they start doing portfolio margin, and they may have heard about this thing about circuit breakers, right? So how does that work, just quickly? So ever since the 1987 crash, the Black Monday crash, right, we have had circuit breakers put in place. So the way they work is that during market hours, level 1 here is 7% down from the prior market close, all right? Then what's going to occur is that you're going to get a 15-minute pause in the market. Then they unpause and they allow it to continue. At that point, you can fall down to 13% down from the prior day close. That's going to then trigger another 15-minute pause. And then at that point, you've got level 3, which is 20% down. And at that point, that is going to halt trading for the remainder of that day. Okay, so these are the three separate circuit breakers that exist with the market when you are during normal trading hours, right? Now, outside of normal trading hours, so this is basically when the futures are at work, then that works a little bit different. And instead of looking at the prior close, they basically look at the VWAP, which is the volume weighted average price, during the final 30 seconds of the last trading day. And then they calculate a 5% down from that point, okay? And this was interesting actually during the Trump election, right? So when everyone was freaking out that, hey, Hillary's not winning, looks like Trump's got the lead. If you were following the futures that night, it was really interesting to watch because we got a huge move down, right? And we actually hit the 5% down from the prior VWAP in ES. Right? So once you've hit that, what's going to happen, as you can see here, is that the limit down is maintained for the remainder of that overnight session. That was opportunity. Unfortunately, I didn't jump into it, but I've got some colleagues that did and made some very nice money, right? Because if you think about what's going on here, is that it's a guarantee that the market cannot continue down further from 5%. Because again, for the remainder of that overnight session, that's it. It's limit down from that point, but it's limit down. Okay, so in other words, you can get long ES at this point with the knowledge that this is a hard stop. It cannot go lower during the remainder of that overnight session until it open the next day, right? And if you guys know what happened here, basically we got a huge move back up such that by the time that the market reopened, it was almost unchanged, right? But the guys that I know that are essentially, futures day traders, in this case, night traders, they made some very nice money here. And they did so with a tiny amount of risk because, again, the 5% level is a hard stop at which there's a limit down on. Cannot trade lower than that for the remainder of the day. Okay, so the next time that happens, may want to, at least dip your toe in and see if you can take advantage of something like that too. Okay, oh, and this thing here about not breaching the 20% down limit. So remember that during market hours, you've got a 20% down max, right, from the prior day. So if if on day one, we basically close at this particular level, then during the trading day, let's say that we actually come down 15%, all right? So we basically hit both of these limits, but then we continue down, but then we closed 15% down. Actually, let's go 18% down, right? Then what's going to happen is that during the extended trading hours for that same day, then you can see that from 18 to 20, which is all that's allowed during one day, so you've basically got room only of another 2 points down, right? You're not going to get through to 5 points down because you've hit the 20% limit down already, okay? So those are the circuit breakers. Any questions on that? Okay, and again, just to cover it, the thing to realize is, if you ask the question, well, does that mean that we can get a 30% gap overnight? Well, with these circuit breakers, it should be no, right? The maximum they can go through the extended trading hours here is 5% down. And at that point, it will halt until the open the next day. The next day, once it opens, then you could potentially go down 20% during that trading day, right? But during the overnight session, you can only gap down or move down 5%. No questions? All right, let's continue. So next up is we're going to look at the space trip. And again, like I said before, if you go to this URL down the bottom, that's going to take you through to a 1 hour, 10-minute full session on the space trip trade. So, and I've been told that many of you have already seen it. So I'm not going to just rehash the whole thing. I wanted to try to give you something a little bit different. So I'm just going to lightly cover it and then give you a little bit more detail. So the whole concept here is this was the very first type of hedge that I started with here, and I was looking to add a hedge, but I wanted something that, as you can see here, so I'd done teenies, which is essentially out of the money long puts that are cheap, and they're fine. They work pretty well actually, but they're negative theta and they get weaker with time, right? So the objective was to see if I could create something that was positive theta and actually got stronger with time, and I wanted it to be as close to free as possible. Okay, and that was the mentality in looking at this particular thing. So, like with anything else, what's the edge, right? With this particular trade, well, one of them is margin efficiency, right? So, what I mean by that, well, at the money is here. So now, hopefully, you now have the foundations of portfolio margin, right? You now know that you go down 12% from at the money, which is this line here. Okay, it's the 12% price slice. And then that there, your T0 risk at 12% down and at 10% up is going to be your portfolio margin. You can see here that it comes through to 1050. And I can tell you that that is simply minimum margin, right? So it's 28 contracts times 37.5 equals that, right? So you might say, well, but okay, what I've also learned from what you said at the very start, that initial margin is not the same thing as margin through the life of the trade, right? We started off with margin of X, and then later on it grew through to blah, right? Well, what's going to happen with this particular trade, I think I've got it on the next slide here, right? So let me kind of fast forward here. So this is what's going to happen after 2 months, right? So same scenario as before. If price does not move and just stays there and we look at what happens, we get a huge profit hump to the downside. This here is the minus 12% price slice. This is above zero. Therefore, my margin is still going to remain exactly the same. Okay, it will still remain as minimum margin. So margin efficiency is definitely one benefit. Okay, we can put on this here, which is one tranche, and notice that if you did this in RegT, this would require $15,000 RegT margin. We can do it for $1,000. That's huge leverage, right? So let's address the next question that comes up, which is, okay, but leverage means danger, right? Well, does it? I've got a thing here, a particular trade, right? And you might say, well, what if IV goes up? All right, well, let's look at that. IV is minus 43, absolutely tiny, all right? So you don't really have much Vega risk with this particular trade as it's structured. And understanding why takes a while to explain, but essentially, you've got a long here, which at the money is closer to, and also this wing protects this back wing over here. So basically, all those things together imply that the back wing, which is where the risk is protected by the front wing here. So, and our Vega is tiny, okay, because it's so far out of the money, all right? Now, you wouldn't necessarily do this in RegT because, again, it would cost you $15,000 margin, and you would be so-called wasting $15,000 of margin for this particular hedge. But in PM, we can put it on for just $1,000, right? So we know that the Vega risk is very minimal here. Now, by the way, if price were to come down and if at the money was here, your Vega would get much more negative, okay? But while price is comfortably in front of the structure, the Vega risk is quite minimal. So what else? How else can we have risk? Well, the other risk we have potentially is delta risk, okay? But you can see here that our delta is 0, minus 0.6 negative, all right? Our gamma is minus 0.001, all right? And just by looking at the line, you can see it's flat, 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 flat for the entire 1SD of the expiration cycle that you're in, which is going to be roughly about 100 days, right? So very, very minimal risk. So if SPX goes up 50 points one day and everyone's freaking out about the bull move, and next day it comes down by 75 and then it goes up 50 and whatever, as price dances all around here, we don't care, right? We're not freaking out, right? So, and then when we come back 60 days later, we have something like this, right? We've got a beautiful profit hump over here, all the way stretching from in front of at the money all the way down to here. All of this is profit, okay? 60 days later. So it does take time to build that profit hump, okay? So let me touch on this. So this is the concept. If you look at, and again, we're trying to explain why does this trade work. So one of them is margin efficiency. The other one is the safety with the location. Since it's so far out of the money, it is has minimal vega risk, almost no delta or gamma risk as well. So we've got that aspect that works for it. The second thing though here is that if you look at the, this is basically showing you the extrinsic, right, value of options. So without getting too deep, what's happening is that the at the money decay is going to have this much here decay between the expiration going from here to here. So, right, so this is basically, you know, going from 143 DTE to 52 DTE. Okay, so that's the amount of decay that would occur. But if you look at that on a percentage basis, you'll see that that accounts for the at the money is going to decay by 40% of its original value. But then the further away from the money that we get, so here we're basically moving out of the money to the downside. Here we're looking at minus 16 delta. You can see that here it's 73% decay. And if we go even further through to a minus 6 delta, and you'll see why in a sec, this is my 83% decay, right? So what we're actually doing is that we're setting up our structure kind of like this here, right? At minus 16 delta and roughly minus 6 delta. And so what's occurring is that the back wing is decaying faster than the front wing, right? So if you look at this graph here, if you think about it, right, if you were to start peeling off some of this wing over here, then it's kind of like saying that this wing over here gets more and more powerful as time goes by. And that's exactly what's occurring. This is why we basically get the profit hump, right? Imagine if this wing wasn't here at all. You would basically just have a put debit spread, and your T0 would basically look like this. It would be higher, right? When you start adding this back wing, it's going to lower this T0 line because you're adding the opposite Greeks, okay? But as time goes by, what's happening is that the decay of the back wing is faster than the decay of the front wing. So therefore, it's, again, like saying that our front wing gets stronger and stronger, relatively speaking. That is why we build a profit hump as time goes by. Okay, and you can see here that with at the money not moving, if it stays exactly where it is, 2 months later for a single tranche, you'd in theory be up $278, right? You can see here just through the line that even if you go even further ahead, you still have a little bit of profit potential there. But for anything that's neutral to bearish, you can see here at the peak of that T0 there, you're up $1,600. Okay, so if you get a grind down market, which most trades tend to not like, this STT loves it, as long as you do have a profit hump there. Okay, so that's that. Now the construction is essentially 10 put credit spreads over here at a set of strikes that you can get $1 when they're 25 wide. And then over here, we basically go through to minus 16 delta. We normally get 4 put debit spreads, and that's going to leave us with something that looks like this. All right, it'll start flat, and then as time goes by, this profit hump here starts to build and gets higher and higher. Rick is saying, for this hedge, do you eventually start to peel off the debit spread as it reaches its full profit? No, we don't, and I'll get to that coming up, Rick. All right, so that's the intention, okay? So our intention is to build up a profit hump that builds up with time, and we've got a downside cushion now, okay? So if you are in a situation that you say, well, all right, fine, but I trade a road trip, and that's what I like to do. I like to do my at the money structures. Are you telling me to simply stop doing it? Not necessarily. you could be doing a road trip here, and then if you look at the, after 30 days, you've got a pretty nice profit hump that's built up there. But notice that, I mean, yes, at the money is decent, but you also have quite a decent spread of profit in front of that broken wing. Okay, so you might say, all right, so there's a 250 point range. Well, if we then look at our STT, in this case, if we do 3 tranches, you can see that we'll then have a 370 point profit range, mostly to the downside. So you could probably see where I'm going. If you put them together, you're now going to be starting off with flatter deltas, and you're now going to be having a very juicy 385 point profit range, and after 30 days in this particular case. And it's a nice way to add a downside hedge to your, not just the downside hedge, by the way, but it also just adds theta. Remember that if at the money stays exactly where it is, after, with a single tranche, you were making $268. In this case, we have 3 tranches, right? So the 3 tranches of the STT would be contributing by roughly maybe $600 extra theta, even if at the money stays exactly where it is. That's not bad, right? But on top of that, if price were to actually come down, we've got a nice cushion all the way here without having to freak out. Okay. Normally, once you get through to the back end of a road trip, where's the road trip? Here we go. Normally, once you get beyond this line here of the back wing, this is where you start running into more risk. Okay. So what we're doing here is that we're basically adding an STT structure here that's going to essentially lift up this entire line and give us a huge landing pad to the downside. So it looks like that after 30 days. Okay. So you can definitely combine the two. And this slide here is just basically saying, well, what if we were to start with the STT, allow it to age by about a month, have the profit hump there, then at that point, add in a new road trip. Now what's going to happen is that if you get an immediate move against your road trip, then hopefully this profit hump over here is going to be able to act as a hedge straight away. All right, so Rick, this is kind of part of indirectly answering what your question was before about harvesting or about peeling off the put debit spreads. We actually peel off the opposite wing. Okay, so we start off with the back wing here. These are the put credit spreads, and we're basically going to be starting off with these put credit spreads for $1 for a 25 wide. And then what's going to happen is that once these guys get cheap, what does cheap mean? Well, that depends on you, but anywhere from, let's say, 10 cents to 10 cents through to maybe 20 cents at the top, right? But somewhere in that particular range, you might say, well, I've already extracted 90% of the profits of that particular wing. Let's just peel this thing off. I don't necessarily need to get greedy and get the final 10 cents. You might say, well, why would you do that, right? Why not get those final 10 cents? Well, the reason for that is because you can then end up with downside hedges that look like this. And these are all live trades, by the way, that I've done in the past. So you can be up money, up $1,000, but now have an $18,000 hedge for the next 17 days. Okay, and this is again what I was referring to before, because you have to be aware of your entire portfolio. So now if you get in through to, let's say, another set of STTs and you say, well, what about this downside risk way over here? Well, guess what? I now have these beautiful put debit spreads that are fully paid for and profitable, right? They've made more money. They're not just free. They've actually put money into your pocket and are now providing very nice downside hedging for either STTs or for your at the money structures, maybe. Okay, and I think I've got another one. Yep, there's another one there. Okay, so we basically peel off the put credit spreads once they get cheap and simply leave on our put debit spreads acting as additional downside hedges, typically for the final 2 weeks of the trade. All right, simple live setup. Let's just quickly flip to and build a live one just so you see it. All right, so I'm going to go through to somewhere above 90 days, right? So normally between 90 and 120. So let's just do December. Okay, so that's at 114 right now. And I normally kind of look down to roughly about 8 to 10 delta and start looking for prices. So my Option Leader Explorer is currently configured for a 25-point strike interval, right? So every row is 25 points away, so it's nice and easy. And all I'm doing is I'm looking for the spread of price to be $1, and I want to go as far away out of the money as I can, such that I still get $1 spread, right? So if I start from 10 delta, if this is $12.95, I would expect this to be $13.95. That's too much credit, so I keep moving away. That's $11.50. I'll be looking for $12.50. It's still too much. $10.15. I'd be looking for $11.15. Too much. 9. I'd be looking for 10. That's close. It's $10.15. Let's see if we can go further away. $7.95. I'd be looking for $8.95. Yes, I could get that. $7 to $7.95. That's not enough. Right? So you can see here from $7.95 to $9. That's the furthest away from the money I can get, but still get a $1 credit for a put credit spread, and I'm going to get 10 contracts there, right? So you can see here that's bringing in $1,000. Then I'm going to go to I'm going to look at the delta column. I'm going to go to roughly 16 delta. You know, could I do this one? Could I do that one? Either one is fine. And normally you'd be doing 4 put debit spreads, and there's your trade. Okay, in this case, our upper expiration line, which is up here, is at positive 90. So it's actually above 0. Our deltas are almost flat at 0.42. Gammas are completely flat, positive theta, very small negative vega. Okay, and there's just a very simple way of building a left trade. All right. Oops. Mix up. Yeah, so that just gives you the guidelines of what I've just gone through. All right, so what's a weakness? So if you were to look at almost any negative vega trade, the negative vega trade is going to be weakest at initiation because the negative vega will be highest at that point, right? Especially with a structure like this, it's out of the money. So in this case, though, our vega is very, very small. It's only minus 59 because it's so far away from the money. Okay, so that risk is absolutely minimal, even from day one. But if you were just completely paranoid and you said, you know, how could I protect this even further during the first, let's say, 30 days, you can do so, and I'll be showing that in a little bit. Right? But on that particular topic, the concept of hedge STT versus a black swan event. Now, let's just go back to that picture there of this particular live trade. Now, if I put this on today and tomorrow we get a August 2015 style event, does that mean that this trade will not lose money? No, it doesn't. It will lose money, right? Why? Well, because an increase in IV, especially a big one, is going to react badly with the fact that you've got negative vega. But the number is very small, so it shouldn't hurt the trade too badly. Okay, if we're starting off like this, and we'll actually go through a sample here, and we'll actually put one of these guys on before the August crash, and then see how it reacts. Okay, so we do want to see a profit hump build, ideally, in order to be able to leverage it on a move down. But even if you had a profit hump, let's say that it's this gray line that you see here, or even the yellow one, right? If you get a massive IV spike, then that any T0 that has, you know, short options in it is going to get pushed down, right? So what you may not be cashing in on, let's say $2,000 in this particular case. It may be smaller. It might be 200, maybe 0. You may even be slightly negative, right? But the thing is that when you then get that one day, you know, immediately after that particular crash, you know, when you get that recovery day or whatever that might be, even if it's just sideways, then you'll get the IV crush, and then everything will come back. Because again, these things are really far away from the money, so you're not really going to get into trouble typically until your at the money gets into your structure. And that, by the way, is one of the exit points that I recommend in the webinar. Okay, so when at the money gets close to entering your structure, you get out. That's it. But at that point, it may actually be a pretty nice time to simply roll it back. So in other words, you get out of that trade, take that loss. It shouldn't be very big at all. But then IV is now nice and high, and it's a fantastic time to initiate a new trade, right? Because now it'll be super far away from the money when you initiate it, right? And then when IV crushes, at that point, you can be up nicely, right? And as a matter of fact, I can give you a live example of that. So if I go to this thing here, guess what that looks like? Okay, so this is a 10 lot hedge STT, and I initiated this trade. I'll show you where. All right, so this is a daily chart. I initiated the trade here on this day here. Okay, and you can see what happened. I know this, you don't really know this indicator, but what this is, it tracks the IV levels. And if IV increases relative to the prior day, it plots a green dot. And if it decreases compared to the prior day, it plots a red dot. And then the dotted line here is a 20-period moving average. It's basically a monthly IV average of what's going on, right? So it gives you a nice visual indication that, you know, here we got a pretty decent spike in IV relative to the average. But then this is the first day of IV decreasing, even though price went down. So in other words, we had a divergence, right? We basically had price coming down lower, and normally when you go lower, IV increases, but here, IV actually decreased, okay? And there were a couple of other technical analysis kind of reasons for entry. So for example, if you look at this prior decline here, and you project it from prior high, you can see we came in right there. And there's also a, if you do fib work, if there's a fib extension here, you can see we also had a 1272 extension from this guy, but also a projection from there. But anyway, that's just technical analysis fib stuff. But the primary thing also was that we were at a decent level of support based on prior lows. We had IV divergence. We had Fibonacci cluster there. And notice where I was setting up my structure. My structure starts at, well, you can see here, right? It starts at 2225. Let's have a look at visually where that is. 2225 is there on a weekly chart. Look how far away from the money that is, right? And yet, in 5 days, it's up $1,000. Okay. All right. Yes. So anyway, so where I was going with this concept here of hedge STT versus Black Swan is that hedge STT is great for when the market is neutral to bearish or slightly bearish, but it's not going to be the catch-all hedge that will protect you from anything, including something like August 2015 crash. Okay. For that, I've designed a different trade, and for that, it's called the Black Swan hedge that I call it, right? And it works beautifully well for that style of event. So for a market crash, a Black Swan event, these things blow up in terms of profits when that happens, okay? So just be aware of that. I don't want you to get the false impression thinking that the STT, the hedge STT, is going to be great protection for the August crash, right? So let's quickly look at that. So let's go to just a test account somewhere, and we will start a new trade, and we are going to go back in time to August 2015, and I like to go to August 12th when I run some tests. I'll show you why. And the reason is this, right? So if you look at this particular chart, see how you've got a really nice hammer candlestick right at support. Looks like you're bouncing, you're about to keep going higher, right? So it's a natural place to say, yeah, I think I probably would have gotten in at that point, okay? So, and it's about a week away from the crash, right? So let's play with that. And we're going to go to somewhere around here. So here we've got 100, so that'll do. Okay, I'm going to, again, look for a $1 spread here. So 630 to 750, it's a bit higher. 510, I'm looking for 610, that's still higher. 440, I'm looking for 540, not enough. So this is the one here. All right, so I'm going to do a 10 lot there, 10. I'm then going to go through to roughly 16 delta. Let's do this guy. Normally it's going to be 4. I'm going to look at this. Here, I see that my upper expiration line is very near 0. It's at -40, perfectly fine. Delta's flat, everything's fine. Okay, looks like a pretty standard type of entry. I'm going to commit that. Just call test. All right, and again, like I said before, right, this trade is going to get hurt on August 21 because it's only got a week of time. That's not enough time for it to build up its profit hump, right? So let's go to the 21, which is the first big move down, but not the terrible move down. So in other words, let me kind of visually show you. This is what we've just gone through. Okay, that looks pretty ugly, right? And most trades would have been already hurting pretty bad on August 21. Our trade is up 130 bucks. Okay, so you can see that it can withstand a lot based on the way that it's constructed and how far out of the money it is. Okay, but price is now getting closer to our structure, and that's the potential risk you run with trades, right? So that if at the money gets inside of your structure and then a crash happens, or very close to the structure and then a crash happens, that's where it can get hurt, right? When price is comfortably in front, this trade is super resilient. But regardless, let's go for it another day. All right, and yeah, it's down 900 bucks though, right? August 24 crash, you're down $900 on one tranche. That's not bad. You might say, well, hang on, you told me this was a hedge. Yes, it's a hedge, but it's a hedge for, you know, so-called normal conditions. It's not a hedge for a black swan event. I do consider this August 2015 crash a black swan event. Okay, IV went up like the most in history, actually the second most in history, right? It was a huge spike in IV, as you can see from the black line here, right? That's ugly. But notice that the day before, again, we were still fine, okay? And on a massive crash event, we're down $900, okay? Now, if you were to do the trades that we do, we have another trade, again, which is called the Black Swan Hedge trade, and that is a trade that blows up profitably when this happens, all right? But what I want to quickly do is go back to the start and kind of just show you that, you know, teenies are can be still very useful, right? So even if we go out through to something like roughly 30 days, and even if I were to spend 50 bucks, all right, no more than $50 just on one teeny here, right? I'm going to commit that. So all I've done is I've spent, so my line, my expiration line kind of is, you know, flatter, and I've got a hook and whatever. And now if you're basically going to go through to August 24, just the fact that you spent 50 bucks, you're up $1,400, right? Just to show you the risk graph in a way that looks familiar. That's what it looks like there. All right, so teenies can work for sure. They can definitely help in crash events. The key is, though, most of the time you're not crashing, right? So they have an actual cost, even though 50 bucks is, you know, pretty minimal. What we do in the community is we actually combine three things together primarily. We combine income versions of STTs. So it's not the hedge STT, they're different versions. We've got about 4 or 5 variants. We then combine that with a Black Swan hedge to protect us from a market crash event. And the Black Swan hedge has a cost, so we then have to finance that cost. So we have those three things kind of put together into what we call a combo, right? And our combos are, again, an STT with a Black Swan hedge with a finance leg so that it pays for the Black Swan hedge during normal times when we're actually not crashing, all right? So there's that. So again, even without that extra teeny, $900 for a crash event is fine. And, you know, again, the average amount of money in neutral market conditions is typically around $400 a tranche, right? So it's kind of like taking a 2 times loss, which is perfectly reasonable, I think. All right, and if you do the $50 teeny, well, not $50, but $50 outlay, which is a 50-cent teeny per tranche, then, you know, it's not much extra cost and will fully protect your trade from a crash. All right, so is it a hedge or is it an income trade? Well, the hedge STT is primarily a hedge, but can be traded for income. I did that for quite a while, right? And again, as long as you're not in a super bullish market environment, then the thing does quite well in terms of return on margin. And again, I was pulling $300, $400 out per tranche, even though it's not meant to officially be an income trade, right, for that. But if you then get like the Trump rally and all that kind of thing, you know, crazy bullishness, then it's not going to be losing much money because, again, the upper expiration line pretty much starts at 0 anyway. But you're paying some money for commission. So, overall, you might be losing a little bit, but it's a tiny amount. Okay, but for neutral to slightly bearish to bearish conditions, the hedge STT is great. This is the reason why I actually initiated the hedge STT just the other day, right? I think we could be moving into that type of market environment now, right? And you can see it's already up $1,000 in 5 days. So let me touch on the new mechanical combo, which is basically what I've just described to you, right? This is a combination of an STT, but not the same one that you just saw, right? It's an income STT, together with a black swan hedge, together with a finance leg for that particular black swan hedge, right? And this thing here is a combo, and here I've called it mechanical combo because this particular trade plan is completely mechanical, right? You just follow the rules, you're done. And this is variation 2. But just to give you an idea of what the risk graph looks like, this is what the risk graph looks like here. So you can see that we've got, nice theta distribution of the lines, right? Nice spacing. It's obviously a positive theta trade. And if you look at this, you might say, well, does that mean that I'm only going to make money here if the market kind of has to be bearish? Well, no, you can see here from the lines, you can still make, perfectly fine amount of money per tranche here, even if you're bullish, all the way up to 1 ST, right? And then you might say, is there risk to the upside? Nope. This line over here basically lands at 0. So even if you get a huge bullish move, you're not going to lose anything there, okay? And later in the trade, you're getting more and more negative delta as well, so that when you do potentially pull back, you can typically just cash in on your profit target, right? Now, if you look at these lines here, you can see that the this one here, the gold line is T plus 57. So that's not a bad kind of thing to aim for. So in other words, if you say, 2-month trade, that right there, this entire thing is potential profit that you can make in 60 days, right? And out of that, this particular combo goes for roughly $500 profit, which is this line here. So anywhere here to there, you'd be hitting profit target. Okay, with a completely mechanical trade plan, which is hedged against a black swan event, like in August 2015, and is an income trade, makes money at the money, makes money even if it's bullish, if it's bearish, and very resilient, as you'll see in the next set of slides. So this one here is the MC1. This is just another variation of the combo, but it's still the same thing, right? An STT with a BSH with a finance leg. This was done by one of our members. He did an even more simplified version of what I suggested for this trade. He only had one exit criteria and nothing more. And he basically got no losses, no losing trades since 2014. You can see the results here. I know it's small, but pretty interesting risk equity curve, right? Then we've got a whole bunch of really smart traders in our community, and one of them is a really good algorithmic backtester. So he said, all right, that looks interesting, so let me run my algorithms on it. So he ran an automated backtest, which was 1,671 trades. So in other words, he's initiating a new trade every 15 minutes from 2014. And here we're basically looking profit target of 600, max loss of 15. This is a pure slap on, slap off trade, no adjustments of any kind. You can see what the initial PM is, and here are the stats. Okay, but the interesting ones to me, this one here, right? So expectancy of $421 per trade, right? If you look at things like average P&L, 420. All right, what's the average loser here? It's minus 1,100. You might say, well, the average winner is 600. The average loser is bigger, but notice that the win rate is 89.47%. That's 1,495 trades out of the 1,671 that were profitable. Okay, so in other words, the expectancy takes care of that. Oh, and if you don't know what expectancy is the percent winners times the average winner divided by the percent losers times the average loser. Okay, so by looking at that, it tells you on average how much money will you be making per trade. And then what this number here is that we say, okay, well, we know that the average days in trade is 35.2. So if we divide 421 divided by the average days in trade, this tells us basically how much money we're making per trading day. Okay. And I recommend that you do the same type of breakdown with your own trades and compare it, and I think you'll be impressed. All right, does it scale? Okay, our trades. And to me, that's a very important question. If it doesn't scale, I typically don't have the time to look at it, right? I want to be able to have trades that scale and go as big as I want them to go. Well, we have another trader here. If you go through to Travels and Trades, here's one of our members that's been a part of the community from pretty much the get-go. And he has traded many different types of trades, road trips, rhinos, M3s, whatever. And you can see from this blog post, which you're free to look up yourself, that he is solely in our trade types, and he's now trading these guys at 600 tranches. Okay? And what you've just seen me do, that was one tranche. He's doing 600 of them, right? I've also got multiple people in the community that run hedge funds, so I don't know what size they're doing. They're not allowed to tell me, but I'm assuming it's big. All right, here's another one of our members. These are all different people, by the way, right? And what I want you to focus on here is not the returns. And, you know, I pat this member on the back for how well he's doing, but I want to clarify that these return levels are aggressive, okay? It is not what I would call standard or even conservative. This guy's aggressive, which is fine, right? You've got to find your degree of tolerance on the risk scale. But when I say aggressive, you might think, you know, a guy that's taking huge risk, if he gets it wrong, he's going to get killed, right? Look at this downside T0, right? Does that freak you out? Well, to me, it doesn't, okay? Because again, remember, risk is T0 and understanding how it reacts, okay? So if the market crashes, is this particular person going to be upset? No, right? They're probably going to make a killing, even more. Right? Yet it's positive theta, and in this case here is up, you know, 100K in 84 days. Then he's you know, kept sending me screenshots, right? After 101 days here is up 132. But again, look at the T0. That's what I want you to focus on, okay? He's keeping his downside risk super, super conservative, right? Keeps going, 117 days here is up even more, is up 141. Look at that T0, thing of beauty. All right, and then at 143 days, again, beautiful T0 to the downside. Okay, but again, this guy is aggressive. I'm not going to, you know, say that, and these returns are not standard, right? I do want to highlight that. My key point here is for you to see just how well controlled the T0 to the downside is kept and how conservative that is. So it's a combination of being able to be aggressive, but at the same time still have a conservative downside. Right? He's actually praying for a market crash. You can imagine, right? If the market crashes by 15% or something, you know, this may kind of come down a bit, right? But, you know, it's a happy day, right? He's not freaking out. Oh, there's one more, right? So, yeah. Again, beautiful downside T0. Okay, so we're at an hour and a half. So I was going to quickly show you the course outline. You know what? I can't spend much time, but I will stuff that quickly show you, but you guys can go there and check it out for yourselves. Here's the page, and then if you scroll down, by the way, it's a pretty crappy sales message. Okay, it's just a video primarily. I need to spend some time making this better, but this is the core, right? You'll basically get to see all of the content here. Each lesson is split up into very, you know, bite-sized times. At the end of each lesson, you get a Q&A at the bottom with all, and you can see all the other questions everyone's been asking. But this is essentially 35 hours of content, right? So we go through foundations here, second order Greeks. You can see here we're spending lots of time on lots of advanced concepts, which I think would really help most traders, right? So again, you know, lots of time on vertical skew and how that works. Then we get into the space strip trade. You can see that there's a bunch of different variations there. We look at a whole variety of downside adjustments, pros and cons for each. right? Look at layering. All right, then we get into the black swan hedge. You can see that we cover about 4 different variations of the black swan hedge there. We then look at upside adjustments. We don't need upside adjustments, but I added a module based on people that were still trading things like road trips and what have you at the time. And they said, could you create some lessons on upside adjustments? So I did that. Then a whole bunch of stuff on toss tips, right? And then a whole bunch of stuff on managing your entire portfolio, which is really important, this module. Okay, and then after that, I've got some bonus sessions here, and which I was covering the live trades that I was doing, and extra lessons and extra concepts and so forth, right? So you can look at that in your own time at the URL that you find at the bottom there. Again, very quickly, we've also got a mastermind group, and this is once you essentially graduate from the course, this is where you should land, right? It's optional, but it is, we talk about a whole variety of different topics, new ideas, new variants. I do a quick market review at the start. We may go through backtesting, but the idea is to collaborate across all of the different traders, right? So we take advantage of new ideas that people will suggest. We take advantage of people that have skills in algorithmic backtesting. We've got various others that do manual backtesting, but then share their backtest results, so that can save you some time. We've got people like myself that come up with new variants, new ideas. We've got other people that then come in and take that and build upon it, and then create additional variants and so on. So it's a really good and active community, right? So you can see here the people that are in the PMTT channel in Slack is roughly about 200. Now it's about 210, I think. But you can see that quite a decent portion of those people are also now in the mastermind. Okay, and that's definitely the most active in there. And you will also get access through to private forums. If you buy the course, you'll basically get this thing here, but you'll also, if you then join the mastermind, you'll get access to this one there. But you can see that if you look at all of these, it's roughly about 900 posts in the forums. Okay, and then we have covered some advanced information, which I'm going to try and squeeze in a little bit in here too. So if you have an IRA account or a Roth, then you're likely trading it, okay? And you're likely trading that with RegT style structures. So once you learn all this stuff, and once you start realizing the power of being able to trade with portfolio margins such that you can have safe trades, right, with the way that we teach, then the next thing is saying, well, hey, I want to start doing those types of things with my IRA. The problem is that most brokers do not allow an IRA, actually no brokers, allow your IRA to trade with portfolio margin. Okay, what you've got to do is you have to, well, actually TDA doesn't even allow your IRA to trade futures options, which sucks. So you've got to move your IRA through to somewhere else, such as Interactive Brokers. They do allow them to trade futures options, not portfolio margin, but there are extra restrictions, right? One of the restrictions there is that they charge what's called triple spend. So if the spend for a position is, let's say, $10,000, if you're trading it with your IRA at IB, they will charge you $30,000, 3 times the amount of normal spend. Okay, that's one thing. The other thing is that they also charge you sometimes additional margin based on using long-dated options. Some of our trades actually go slightly beyond 120 days, and with some of those, they like to then whack you with more margin because of that, right? So that's not ideal. So I spent a few weeks and started negotiating with other brokers and all this kind of stuff, and we're now in a situation that you can do some pretty interesting stuff. So one of them is that you can form, let's just call it a business entity now, and that business entity here, let's just call it business entity, right? And you've got your IRA over here, okay? So again, IRAs are not allowed to trade portfolio margin, but we can get around that fully legally, okay? So what happens is that we form this particular business entity, we then put the money from the IRA into this business entity, and this business entity is the one that opens up an account with a broker, right? At this point, the broker just sees this as a business entity. They don't care what money is inside or who it belongs to. Again, this is all fully legal, right? So what happens here is that the broker, providing you've got 125K of money in here, right? Your broker will say, yep, portfolio margin, super, fantastic, go for it. Regardless of the fact that you're actually then going to be grabbing IRA money and putting that IRA money into this business entity. Okay? And just to be clear, I'm telling you that by doing this, you will now have information that will allow you to trade your IRA with portfolio margin and get the super cheap commissions, right? Because remember, you can get your IRA, take that through to IB, and now have the triple span penalty, have the long-dated options penalty, okay? And you're having to trade span, which implies bigger commissions, right? Like I explained at the start. All those things aren't great. So what we can do now is, instead of doing all this, we can basically go the other way and end up being able to trade the IRA money in a portfolio margin account with this business entity, which is nice, right? The other thing that's cool is that you can actually, let's say that your IRA has $75,000 in it, and then let's say that you've got personal money of $75,000. All right? You can have this business entity put both of these guys in. Therefore, this is now at $150,000 and gets a proof of portfolio margin. So you can blend personal money with IRA money in the same business entity and get an aggregate amount of funds and simply trade that as if it's like your own mini hedge fund. All right? On top of that, if you want to, you can get family money and bring it in through that same business entity and trade that. The only restriction is that you're not allowed to charge management fees or performance fees. Okay? But you can actively trade it fully legally. All right? So we have full information on that available inside our Trading Dominion community, which I think is pretty powerful stuff. Okay? You won't find that anywhere else. Next thing here is the mastermind group. What are we up to? Do we just sit around doing nothing, or do we collaborate, right? Well, you can see here in the last few months, we have created 34 new trades, right? And all fully documented in the forums, right? And then some, right? So this is an ever growing kind of stuff. Again, there's huge collaboration with some really smart traders in here, and it really is a great community, okay? But you can see here there's a whole variety of stuff that we've been creating as we go. So just to give you a look at some of them, this guy here is called the Shark. So you can see we can start to get very interesting T+0 lines, okay? This guy here is another Shark variant. This guy here is what we call a T5, right? And again, these are not the types of T plus X lines that you're used to seeing, right? And then here, this is a back test by one of our users. And again, some very interesting stuff, right? You can see here that his back test, he ran through 26. So from 2015 to 2017, he total of 26 trades, 23 winners, 3 losers. Largest winner, $3.8 thousand. Largest loser, $900. Okay. Now, by the way, if you've not seen these types of trades before, don't think that they have no risk. Everything's got risk. Okay. So whenever you see kind of curved lines in risk graphs, that basically implies that you're using multiple expirations. And if you're using multiple expirations, if you've not experienced that before, the entire trade, including the expiration line, can move up and down. Okay? So just be aware of that. So even though it looks absolutely beautiful, which it does, right? It doesn't mean that it has no way of losing money, because if you're just looking at T plus X, you go, that's impossible. There's no risk anywhere, right? Well, okay, but the thing is that the whole thing can potentially sink down, just like any other trade that uses multiple expirations, right? So I do want to clarify that it's not a riskless trade. That a riskless trade doesn't exist, okay? But again, it's very interesting to be able to trade T plus X lines that looks like this. Right. This one here is a pretty funky one, called the Golden Arches. Quite interesting. Okay, quite resilient too. And notice all of these guys have nice negative deltas all the way through the trade, right? And positive theta. Okay, as a matter of fact, it's got positive gamma, right? So if you've been trading, and if I told you that we've got multiple trades now that we have positive gamma and that are positive theta, you'd probably look at me strange going, what? Right? Normally, positive gamma means negative theta, right? Here you can see we've got positive gamma and positive theta of plus 40, right? Okay, so in terms of the deals, I touched on this before in terms of what happens with commissions. I told you about TDA and IB. We've now got negotiated deals specifically for us that we can get 40 cents a contract that goes to the broker, 25 cents a contract to the execution platform, which means a blended rate of 65 cents plus exchange fees though. But still, 65 cents is a full 20 cents better than what interactive brokers will give you, and a hell of a lot better than what TDA will give you, right? So if you want to do span margin, you can go with the broker deals that we have. And if you remember that if you want to do portfolio margin with your IRA, we now even have a better deal than this, because we can now use that business entity and then end up getting portfolio margin capabilities on that entity, which the IRA can put its money into. All right, and then deals on software. So we've got some discounts here on OptionNet Explorer that you can get once you join, and then we've got a 30-day trial of OptionView as well. All right, and before everyone starts asking, which one do I prefer, OptionNet Explorer or OptionView? I prefer OptionNet Explorer, right? But it's kind of like a religious thing, right? Some people love OptionView, some people love OptionNet Explorer. I've got my own reasons for liking that. So, all right, we're at the end. So 1 hour 43, so just managed to squeeze it in. So I know I had to rush a little bit, but feel free to ask me anything you like.
Yeah, let's look for a couple of questions locally here, if we may.
Hey, Ron, excellent job. That was a fantastic presentation. Thank you.
Sure.
So I guess my question is, at one point you were talking about pulling off or peeling off the backside of your trade, and you had just a beautiful, T+0 line reaching towards the sky there.
Mm-hmm.
I've done that once before when I was doing the road trip trade and was entering it in every 2 weeks.
Right.
And then, the only opportunity I had to do that was when the market just skyrocketed.
Right.
But in this case, it seems like you could do it all the time.
Right. So realize that what's happening is that we're initiating the put credit spread at about $1. We wait for it to lose most of its value. And then at that point, we peel it off, right? So once it gets through to somewhere between 10 and 20 cents, you can peel that particular thing off. Now, at that point, if you think about it mathematically, you might say, well, hang on, that implies, therefore, that the entire remaining risk graph should potentially have to be pulled down, right? Because that's a debit operation, right? You're essentially having to buy now a put debit spread over the top of your put credit spread for, let's say, 10 cents. That's a debit, and that's true. But what normally happens is that you can then peel off a couple of the put debit spreads that you've got in the front to even that kind of thing out, and still be left with a positive number here, right? Basically a profit, but still have, typically for around about 2 weeks, for the final 2 weeks, you can then have, this kind of scenario that can just peel off those put credit spreads and leave yourself with nothing but raw put debit spreads that are more than fully paid for, and now act as a really strong hedge to the downside, regardless of even in a market crash scenario too.
Yeah, that's wonderful. Is this the Black Swan hedge?
No, definitely not. Black Swan hedge is completely different. So the Black Swan hedge is primarily a Vega and VOMA hedge. Sorry, I haven't explained VOMA. So VOMA is the rate of change of your Vega. Okay. So just like you've got delta and gamma, right? And gamma is a rate of change of your delta, which hopefully everyone's familiar with. So VOMA is the equivalent for Vega. So it's a rate of change of Vega. So what you want for a market crash scenario is you want something that's positive Vega and positive VOMA, right? So that when that crash happens, the thing just explodes, okay? And yeah, that is completely separate to the hedge STT, completely separate. So it's primarily a Vega hedge, whereas the STT is more of a delta hedge, in my opinion, right? It just creates a profit hump for a grind down market or a neutral market, whereas a Black Swan hedge is for a Black Swan event when IV just goes nuts.
Got it. Thank you.
Sure.
And Ron, thank you, Ryan. And Ron, it has been said publicly that it's along the lines of a back ratio spread. Is that correct?
Yes, that's correct. But it's specifically constructed, and it's also, again, you saw it in the course outline that we've got about 4 different ways of doing it. And we've then got a variety of ways of financing intelligently that's cost. Because any kind of downside protection that you buy for a black swan event is going to cost money. So what we've got is we've got various strategies for financing that. And again, they're specific, right? And so we teach about 4 or 5 different financing strategies for the black swan hedge by itself. But then we also try to keep things simple by doing the mechanical combo that I showed you here. So this thing right here is from day one, it's an STT, an income STT, not a version that you've seen, but similar, let's just say, right? But it's an income trade combined with a black swan hedge, combined with a finance leg from day one, completely mechanical, no thinking. You just put it on, it looks like this.
Yeah, that would be the ideal, to have a complete system. Michael had a question.
Ron, thanks very much for all you've done here. Just a trivial question about your T plus X lines.
Sure.
What are the spaces or the quantities between them or at them? T plus 10, T plus 20, whatever.
Okay, and if you look down here, I'll give you a copy of the slide so you can look at this, by yourself. But from the blue to red, it's 19 days. Then from the blue through to the gray, it's 38, and to the gold, it's 57. So that's why I was saying that this line here, this is essentially 2 months out, right? So in 2 months, this is the profit hump that you should be able to cash in on.
Hello, Ron. It's Brian Johnson. We've talked about this issue before, but it looks like in your advanced strategies, you have multiple or options with multiple expirations.
Yes.
Are you doing any modeling with respect to true Vega, and how are you actually capturing the Vega of those strategies?
Right. So when it comes through to the time trades, you saw that we've got a list of like 34 trades that we came up with, right? So roughly maybe half of those are what we call time trades, and they're going to be using multiple expirations. And that's definitely when you feel the Vega impacts, you feel skew impacts. There's a difference between parallel shifts versus normal weighted Vega type shifts and stuff that you likely know already. So what we do there is we've created, and I know some people have done similar stuff as well, right? But we've essentially created pricing tools that automatically track the history over the past 2 weeks of that particular structure. So that enables us, well, first of all, we're starting with a base that's been backtested to show that both algorithmically and manually, right? Backtested and algorithmically, I think the test was over something like 50,000 trades or something crazy. So it's shown to have good expectancy, right? So we're starting with a solid base, and then with that solid base, we're then taking the pricing tool, and we're using that to we're using that as a timing mechanism to tell us when to get into a trade to hopefully increase our odds and give us even better odds than what the completely algorithmic backtest showed that we already had good expectancy with.
I had a question, Ron.
Yes.
The underlying edge on this system, on general, on Butterfly's trades, I believe the underlying edge is pricing inefficiency in the market, where we find that options are systematically overvalued, particularly on the downside.
Right.
Is that still the case with this strategy, or where is the edge coming from?
Okay. Well, if we go back through to the edge here, right? So we're basically looking at margin efficiency is definitely an edge with this particular trade, right? Because it's a minimum margin trade, and the margin gets essentially, it doesn't change. It shouldn't change much because we maintain minimum margin through the life of the trade normally. Okay. So margin efficiency is definitely one. The second thing here is that the Vega risk is tiny here, which is typically the risk that you have with income style structures, right? It's more vega than delta typically. So that is something that's been minimized. But the other thing, based on what you see here, is the fact that this swing here is going to decay faster than the front wing. And therefore, that is what builds up that particular profit hump. And actually, in building that particular profit hump, what happens is that our delta ends up getting more and more negative as time goes by. It's called negative term. Okay, but essentially, which is a good thing. So in other words, we're not adding risk to the upside, but the risk to the downside is getting less because we're getting more and more negative delta as the trade actually goes with this particular trade.
Yeah, these are beautiful characteristics that you set up. Would you say that this still requires a market in which volatility is overpriced, or could it work even without in a other market?
Right. So what happens, the way that the trade is created is based on price primarily, because remember that we're basically looking for a dollar credit here, right? So what's going to happen is that when IV is high, then the location of this particular put credit spread in terms of at the money is going to be far away, relatively speaking. Then when IV is low, the distance away from the money is going to be less because of the way that IV expands and contracts in terms of the distribution, and our put credit spread may end up being somewhere here. So therefore, our put debit spread may be something like this, and well, it's going to be higher, but it's probably going to be like here when IV is low. So it's going to be closer to the money. Therefore, when it's closer to the money, the ramp here, which you can see here, typically is very, very flat until we get to the structure. And if the structure is now closer to the money like this, now the distance from here to here is less than the distance from there to there, right? So in being closer to the money, we've got less ramp to the downside. So you might say that therefore the risk is increased, and also the negative vega of this trade, which is closer to the money, is going to be a bit higher as well than the one that's further away. So purely from an STT perspective, a hedge STT perspective, yeah, sure. Is there a benefit to initiating the trade when IV spikes? Absolutely, right? But you may then say, well, but IV's been historically very low over the last few years, so does that mean that you're not trading the STT? Not necessarily, because again, this structure is already very far out of the money anyway. So even in low IV, it's still far out of the money, okay? So that's one thing. The second thing I'd say, though, is that when you're looking at the combo that we do, so this is not the hedge STT, now I'm talking about what we teach in the course. So the combo is now looking at an income STT with a BSH plus a finance leg, right? Now, if you look at the individual components, the STT would prefer IV to be high, ideally, but the BSH actually prefers the IV to be low.
That's true.
Right? The same thing would go for the finance leg in theory, right? IV high for the finance leg too. So what happens though is that when we combine these things together, they balance each other out. So what I mean by that is that you would have something that looks like an STT, it won't look like this, but it looks something like it, right? And then you'll have the BSH protection back here, right? And then you'll also have a finance leg. But the point is that when IV is high, like I said before, the STT will be quite far out of the money. The BSH will be further away from the money. But when IV is low, this STT, even though you might say, well, this STT is now going to be closer in, but so is our BSH because IV is low, right? So since they're both closer to the money, they're both adequately protected. Well, in other words, the BSH is always, it's like a buddy, right? The BSH is always going to protect the STT. If IV is high, they're both going to be further away from the money. If IV is low, they're both closer to the money. So if you do get that crash event that people are scared of, if you're trading it as a combo, you're still fine. And you can verify this for yourself and you can backtest it, right? Put it on during low IV before, you know, a big spike in IV and a big market crash or whatever. You'll find that this BSH really kicks in fast now because it is closer to the money.
Do you think the BSH can make a long-term positive contribution over time?
Well, when traded as a combo, absolutely, right? These three things work as a family, right? Most people tend to trade one trade as a trade. and therefore they're shopping around for the ideal market condition for it, and that's fine, right? But in my opinion, the really nice thing about the combo is that it's simple because you can apply it in any market condition. When IV is high, it works. When IV is low, it works without having to change the components. The components simply adapt to the market condition, but they're balanced trades. So if you're trading them together, you can put it on whenever you like.
I love it. Ryan has another.
Hey, Ron. So with high frequency traders entering our market, options market, and trading credit spreads and artificially keeping IV low, you know, it's kind of a change in market regime that we've all had to adjust to. Yep. Is there any sort of change in market regime that could affect or remove the edge from this trade? What have you guys brainstormed in your community?
Well, it's more or less the same thing that I was talking about before, right? By combining those elements together, you can absolutely trade it in low IV and still sleep perfectly well at night. Because if IV spikes, that black swan hedge is going to blow up and make lots of money, right? And still more than adequately defend that STT that's closer to the money now, because they follow each other, right? When IV is low, they're both closer to the money, so it's still perfectly well protected.
Do you have any questions, Ron, that you want to cover from the online users?
No, I think I actually have.
Okay.
No, I've actually answered everything that's been asked online.
Does anyone have any other questions here in the room? If not, I mean, you've stayed with us for an extraordinarily long time, and we're extremely grateful for it gave me all sorts of unique insights. I'm going to start putting some of these trades on myself. I'm already calibrating how to do that, and we'll pursue that further in our group. I hope you get some people who sign up for your community too. Let's have a really nice hand for And Ron, if you want to add anything, go ahead. Otherwise, we'll call it a day from our side.
Yeah, no, that's it. So I'd suggest, just check out the outline and the video that I've got on that particular page if you want more details. It covers stuff that I haven't had time to get into today, like all the spreadsheets that we provide and all that kind of stuff. And if it's to your liking, then maybe talk to someone that's part of the community, right? And you'll see how happy everyone is. So that's pretty much it.
Thank you so much. Good night for now.
All right. Talk to you later. Thanks.
Thanks.